Hi friends, we are starting a face-to-face offline batch in Bangalore with SS Academy. That is for CA Final Financial Reporting paper number 1. Yeah, we'll be taking exactly 2 months from 1st November to 31st December. We'll complete it. It is starting from 1st November 2022. Yes, and in Jayanagara branch of SS Academy, we have morning batch and evening batch will be at Seshadripuram SS Academy. Right, and if the student is missing because of any reasons, right, they are going to get a backup class. All right, we'll ensure that their things, they will study and complete. And from the face to face batch, you know the benefits out of it. We'll be completing the syllabus in time. You don't need to postpone and you don't need to compromise for your goals. See you in the class. Please share this information with your friends. That will help me and as well. Thank you. Next, for my books, that is an Ind AS Made Easy, our financial reporting Made Easy, and fast track summary book. Yes, you can order in ravikanthmiriyala.com, or you can contact the given number for the books. Right, for your doubts, clarification, please join the Telegram group Ind AS discussion group RKM. Let us look at Ind AS 27, that is separate financial statements. Yeah, see the separate financial statements, as per Ind AS, it means financial statements means only consolidated financial statements. The standard will not say who should prepare separate financial statements. If you are preparing separate financial statements or you are exempted, you exempted from the consolidated financial statements, then how to measure the investment in associate or investment in subsidiary, investment in joint venture? That's all. Right. A company, as per the Ind AS, and same conditions are there even as per the Companies Act as well. A company need not prepare consolidated financial statement if you satisfy the following. I can say 3 conditions basically. Right. That is first one, it should have not listed its debt or equity in India or outside India. It should have not listed. And second, then they should have informed their investors, that is the parent company and non-controlling interest, that we are not preparing the consolidated financial statements, and you should have got the permission from them. Next, I am not preparing consolidated financial statements, at least my parent company or ultimate parent company, intermediary subsidiary, someone must be preparing the consolidated financial statements as per Ind AS, not as per IFRS or any other gap. They must be preparing as per Ind AS, and that financial statements must be made available to the public. Under that circumstance, yes, you, the middle company, middle subsidiary, you don't need to prepare consolidated financial statement. You can skip the responsibility. Right. And if it is an investment entity, yes, investment entity means we are getting the money from different investors and we are investing into different companies. Yeah, and because you invested into different companies, you may be having some associates or joint ventures, or it may be subsidiary also, some circumstance. An investment entity is exempted to prepare the consolidated financial statements. It is supposed to prepare it under FVTPL. Only FVTPL option is there for them. That means investment in subsidiary, investment in associate, investment in joint venture, they have to measure it at fair value, and the fair value fluctuations will be routed through profit and loss statement. Right. That, as I said, the investment is in subsidiary, associate, joint venture, not preparing consolidated financial statements. Under that circumstance, this is not for investment entity, other entity. Other entity has 2 options. One, you can measure it at cost. Cost means what you lost, total purchase price and all costs directly attributable to acquisition. Right. And the second one, you can measure it at fair value as per Ind AS 109, it says. That means fair value in the sense it can be fair value through P&L or fair value through OCI, FVTPL or FVT OCI. Any one method you can follow it. Right. Here there will be some 2 circumstances, my dear. One, situation number 1, what I say, it was investment entity, now it turned into normal entity. It was investment entity, it turned into normal entity. You mean, when it was investment entity, it must be preparing under FVTPL method. Correct. Now you are going to non-investment entity, then you can prepare at cost, or you can prepare at FVTPL, or you can prepare it at FVT OCI. right? See, if you are preparing at cost, I mean, you don't need to go to the original cost. The fair value on the date of change in the classification will be considered as the cost for the normal entity. Yeah, that is a deemed cost. And no, sir, I want to follow FETPL. Then where is the problem? No problem. Sir, I want to follow FETOCI. You follow from now onwards whatever the fluctuation change. I mean, fluctuation in the fair value of the investment will be routed through OCI. That's it. And situation number two. Yeah, it was a non-investment entity. Now it is becoming an investment entity. Means it was non-investment entity means you must be measuring at cost or FETPL or FETOCI. Correct. Now you are going to investment entity. That means you have to measure it FETPL. Okay, no problem. Right. First point is what? If you are measuring at cost. Now today on the date of change in the nature of the business, then you have to measure it at fair market value. And if there is any gain or loss today, that will be transferred to profit and loss immediately. Right. Sir, I was measuring at FETPL already. You are measuring already FETPL. You are going to measure FETPL. Then there is no accounting. No, sir, I was measuring at FETOCI, sir. Now I have to go to FETPL. See, with respect to balance sheet item, if it is already at fair value, correct? It is already at fair value. That's why you don't need to bother about. But what about the FETOCI means whatever the gains or losses so far you recognized through OCI? Correct, na? Right. You should treat it like, what is that? You should treat it like FETOCI investment has been sold off immediately and you bought it at on the date. Today only you purchased it. Like that you have to assume it. Yeah. If you sell the FETOCI investment immediately, under few circumstances you will transfer it to directly retained earnings, or under few circumstances you may be transferring it to P&L statement, depending upon the type you are supposed to consider. Next, if it is a dividend income coming from the subsidiary or associate or something, yes, you as usual generally, I mean as per Ind AS 109, you transfer it to profit and loss whenever the right to receive is established and there is no uncertainty with respect to collection. Right. Next, last one, if it is a first adoption, you have a choice, that is deemed cost. What is the deemed cost? Fair value on the date of transition will be considered as deemed cost, or whatever the carrying amount as per the previous gap only can be considered as deemed cost. Otherwise, no sir, we will really remeasure the cost and etc. Means yes, you follow it. That's it, my dear. If you feel this video is helpful, please share it with your friends. Let that be helpful to other friends as well. Thank you and wish you the very best.